Investment risk is typically categorized as systematic or non-systematic. Within each of those broad definitions are several different types of risk. Systematic risk is also known as market risk. This type of risk affects all companies. This type of risk also influences a large number of assets. Non-systematic risk, or unsystematic risk as it is sometimes referred to, is often known as specific risk. This type of risk affects a much smaller number of investments and is typically associated with a specific product, company, or industry. The first of those is interest rate risk. That is where the risk that the value of the investment will go down because of changes in interest rates. There's also inflation risk. That is where the risk of prices of goods and services would go up, thereby reducing your purchasing power. Currency risk is a third type of systematic risk. Investors are only impacted by this if they invest in international securities, and that is the risk of converting money where the current exchange rate may have moved negatively against the investor. Liquidity risk is also systematic risk. That is the risk of not being able to buy or sell an investment as quickly as needed because there is a lack of quantity of buyers or sellers in the market. One final type of systematic risk is socio-political risk. That is the risk of instability or unrest in one or more countries of the world. Terrorist attacks, war, pandemics are all examples of socio-political risk. Now let's discuss non-systematic risk, or specific risk. Management risk, which is also known as company risk, is a risk that bad management decisions within a company can have an effect on the performance of that company and its stock. Credit risk, also known as default risk, is the possibility that a bond issuer will not pay the interest as scheduled or pay the principal at maturity. Credit risk can also be a problem with insurance companies and collecting interest and income as expected. There are several different ways to combat the various types of risk, primarily within systematic and unsystematic. Systematic risk can be combated by building a portfolio that has investments that react very differently to the same economic factors. Invest in assets that have an inverse relationship to one another, which would ultimately minimize the impact that systematic risk can have on your portfolio. To reduce risk that is unsystematic, it is important to diversify investments across each major asset class. The impact of a single company that fails then wouldn't be as significant if that company is just one of many that you own in your portfolio. Finally, and most importantly, the decisions you make or choose to not make are also risks. Investing in something that has moved up a great deal increases the odds of buying at a market peak. Selling in a market downturn locks in losses and potentially causes the loss of potential future gains. Emotions play a significant part in investing. Be sure to manage that risk as well as you can.